Hello everybody and welcome to today's video entitled The Most Undervalued Growth Stocks. So it's a video series I do every Friday, even when I'm on vacation, like right now. And I try to reevaluate my stocks on their growth potential and how much are we paying for the growth. If you're new to the channel, I invest in hyper growth stocks. That is, stocks that for me will grow at least at 30% revenue growth or more. The reason why I choose that as a target, why I consider anything under 30% growth of revenue no good, the reason for that is because I want to double monetary inflation, which I estimate to be at 15%, despite the Fed bluffing that the money supply is going to get reduced. It's not going to get reduced. They just planned another $2 trillion a year of deficit for the next 2 years that they just voted on today, which is why the stocks are up. So no, I estimate 15% is the right monetary inflation over the long run, and you got to double that because the goal is to have a decent return. If you do a 15% real return over 5 years, that's about a doubling of your money in 5 years. And so to do that, to me, you have to grow at 30%. The only type of companies that can grow at 30% revenue growth consistently are not going to be established companies that everybody agrees on. They're not going to be consensus companies. They're going to be companies that disrupt or that have a disruption potential, which is why I focus on disruptive, innovative, high-growth stocks. And my style of investing can be really summarized with a product adoption curve. You may have seen this, or if you've ever studied business, for example, it's a classic product adoption curve where you have products which is usually criticized early on. People don't agree with the product, people don't understand it, and then you have what we call an S-curve of product adoption, where the products sold by the company get adopted really fast. And the key for me is to not invest too early, because you may be wrong about a product's adoption, so you don't want to be too early. That's why I don't focus on what I call pre-revenue companies, or companies that are not optimized for revenues yet. And you don't want to be too late, getting out too late either, because then the growth is not going to be 30%. You really want to be in the sweet spot of getting in a stock, early enough, but where that stock is stable enough and where you have enough evidence of adoption. And by the way, we get evidence of adoption when you look at a market at about 5%. Like, for example, electric cars, big adoption. They're at about 5 to 6% of the market. We are like right at the beginning of the S-curve, and we know. I strongly believe that S-curve is real, and that adoption is going to happen. And the key is really to try to get in early, at the early signs of a new product being adopted, and getting out when a product is mature. And that whole period, historically, typically, is like 10 to 15 years, right? So that's the reason, for example, if you look at a stock like Apple's period of hypergrowth is over, right? The good period to buy a stock like Apple was 2010, 2012, and now we're 10 years later, and Apple is not growing as fast as it used to be. So these are stocks that I typically plan to hold for 10 years. If they are on this spreadsheet, it's going to be a 10-year hold. One last thing, for my style of investing, it is gross profit that is the most relevant, because GAAP accounting is really unfair to a lot of growth companies, and I follow these companies qualitatively first, right? I look at the management first, and so these are companies where I generally trust management to invest anything below gross profit in the income statement. I generally trust them to invest it wisely, and that's where we get into debates. Like, if you're going to use net margins, you got to get into a debate, is marketing an expense? Is it an expense, or is it an investment? For a lot of my companies, for example, I consider marketing to be an investment and not an expense. But with accounting, it's included as an expense. Anyways, topic for another video. Last thing I do is I remove debt. I remove debt from my market caps, and therefore I use enterprise value, because I do want to punish companies that have a lot of debt, because debt is that binary risk, right? When a company has a lot of debt, you're introducing the binary risk of bankruptcy. If a company has no debt, typically, I mean, you can't go bankrupt without debt. So you gotta adjust for debt in the model. And in the model, I use EV because EV adjusts for debt and punishes companies that have a lot of debt. So let me go ahead and answer the questions, of the thumbnail, which is the most undervalued growth stocks. And remember, I rank my stocks, but which are the most undervalued? The most undervalued right now is HIMS, and HIMS was not the most undervalued actually about a month ago, but the stock has dropped quite a bit, and now it's the most undervalued. Second most undervalued is StoneCo, and the third one is Lovesac. It's actually backwards, but you get what I mean. I'm really on vacation, gosh. Anyways, these are the top three least valued stocks. And quickly, how do I say this? Like, how do I judge a stock's valuation? Well, I use this enterprise value over gross profit over revenue growth. This is a spin on the PEG ratio from Peter Lynch, but PEG, earnings, stands for earnings growth, and I obviously don't use earnings in my modern day stocks. I use gross profit and I use revenue because, like I said, I trust the companies to invest wisely anything under gross profit. And the question that I ask here is, how much am I paying for each percentage point of growth, each percentage point of forward growth, next 4-quarter revenue growth? How much am I paying for those? And, I want to pay as little as I can for that upcoming growth. I want to pay as little as possible for that upcoming growth. That's why the lower the number, the better it is. The higher the number, if you look at a stock like Nvidia, the higher the number, the worse it is. You're paying up a tremendous amount of money for that growth. And that's where we get into the most expensive stocks, the stocks that I've sold, actually. I used to love these stocks very much. Very great companies, especially Nvidia. But it's a nosebleed valuation. I could not own Nvidia right now when I'm paying a 5 for growth on my EV to GP to RG ratio. I'm paying a 5.36, while my average on all of my stocks is 0.65. So Nvidia is almost 10 times as expensive as the average stock in my channel that I cover. And by the way, most traditional value people who look at these stocks, they would consider all of these stocks to be overvalued. All of them. I can't think a single one of these stocks would not be considered overvalued if you look at it for traditional value investors, PE, price to earnings type of investor, right? They would all consider it overvalued because, like the folks on CNBC, for example, they would probably consider much of these stocks overvalued if you're on CNBC because, you're going to be like, okay, well, earnings make sense, GAAP makes sense, right? Let's pay a lot of taxes. Anyways, that's let me move on. So what I do then is I'm going to go for each megatrend and tell you a little bit about the stocks into each megatrend, but feel free to stop the spreadsheet and look at the numbers that fit the stock you like the best and that really help you with your process. But I'm just going to go through for each of them. And by the way, of course, when I'm on vacation is when the market goes up like crazy and when there would be enough meat to do like 2 videos a day. I really want to make all these videos, but I can't. I'm literally on the road. I cannot make these videos. But I listen to CNBC on the radio, and anyways, it's there's just so much noise, and it's as though a lot of the traditional media, financial media, doesn't want to believe that this rally is happening, but this rally is happening. And Tesla, I mean, absolutely insane. It's back at $215, $216 a share in almost no time. Yes, because the debt ceiling was passed, right? Because interest rates are, we may get one more hike. Who knows? But at this point, nobody takes the Fed seriously because there's $2 trillion of deficit each year that are going to be able to be financed, that are going to need to be financed by the Fed. So we know there's 2 plus 2 trillion that's going to be printed because who buys bonds anymore these days? Right? It's going to have to be the Fed. Anyways, different topic, but of course, that tells us a lot about the cost of capital in the future. The cost of capital is going to go down. When the cost of capital go down, it's going to make buying a car, borrowing money to buy a brand new car easier. And that's really going to help Tesla because most car buyers are what we call monthly payment buyers. And so they look at the payment, and as interest rates are easing inevitably because we don't have a choice. That's why the channel is named Beat the Denominator. we don't have a choice when more QE is the only way. That means that interest rates are going to go down, and thus the sales of a company like Tesla are going to go up. Tesla is a serious product adoption company. There's multiple curves of product adoption going on at Tesla. It's beyond just the cars. You have charging, you have the infrastructure, you have a small solar business, you have the trucks that are coming, the semis, the AI, the self-driving. There's a lot going on for Tesla. But of course, the main product itself, which is the cars, is following an adoption curve, is getting adopted. And it's at about 4% right now, a little bit more than 4% of cars sold are Teslas, 6% are EVs. That's the statistics right now. So this is a company that has, I believe, 10 years of product adoption. What's another company that has a lot of product adoption going on is Enphase. Enphase, really a revolutionary company, really the pioneer of a microinverter. Used to be for solar panel installations, you would get a heavy string inverter that would cost thousands of dollars. You set it up on a wall and it lasts 12 years and a half. So it has a small warranty, and whenever there's shadow on a solar panel, a little shadow takes your whole system down because the system is wired in series. And then come a company like Enphase, and they pioneered the microinverter. And Enphase is the absolute leader in microinverter. Microinverter is the technology, I believe, of the future for solar panels. One panel, one microinverter. They're a tiny little box, and that tiny little box of course, turns DC current into AC current, and AC is what we need for our homes, right? And so it's kind of a chip company of solar. It's a chip company for solar, and they're going to benefit tremendously from the IRA. Enphase, for example, the new incentives under the IRA are absolutely ridiculous. Enphase is also going to benefit tremendously from the rates going down, because these installations, they can cost tens of thousands of dollars, and so a lot of people will finance them. Enphase will benefit from the increase in the cost of traditional energy. It's a wonderful company, and I believe that companies like Enphase and Tesla are actually complementary. If you look at them, Australia is a good example of what's going on in solar and learnings. We can gather a lot of learnings from Australia as to what's going to happen elsewhere. Is they often match things up. Like you can have an Enphase microinverter type system, and you can match it up with a Tesla Powerwall, for example, because Tesla Powerwalls are kind of a consumer brand of batteries, but Enphase is also launching its batteries. Anyways, this is not a video on Enphase. There's a lot of good stuff going on for Enphase. And then I have a micro play in my Energy Revolution stocks, which is STEM. So STEM is the main reason why you would invest in STEM is the software. They have Athena software, which is an energy management software for battery packs. And so battery packs are going to be part of the future of the grid, part of the future of industry. For example, electric trucks, electric semis, you're going to need a battery pack because you're going to want that megawatt charger. You're not going to want to charge an electric truck over a 12-hour period. You're going to want to have it charge in a minute. And the only way to have it charge in a minute is to have a giant battery set up on the manufacturing facility, on the distribution facility, etc. And that's what STEM does. STEM sets up these giant factories, and they set up actually still mostly Tesla megapacks. The Tesla megapacks are still mostly being set up by STEM. So STEM is kind of a co-competitor with Tesla. It's very interesting. They both compete because Tesla has their own software, the Tesla software, AutoBidder. So they compete with Tesla. But they also cooperate with Tesla because they also install Tesla products and sell Tesla products. And STEM is an interesting business. Teeny, tiny portion of my portfolio. I sleep well at night. This stock is cheap. We'll see where it goes. And of course, Tesla and Enphase are two of the biggest positions. Tesla is the biggest position in my portfolio. Enphase is not the biggest, but it's a stock that I'm really accumulating and that I want to own more of because I see these companies having 10 plus years of growth, and they are the uncontested leaders in their respective megatrends. They're on top of their megatrends, uncontested leader in their megatrends. Moving on to another, I believe, uncontested leader in its own megatrend, or at least not exactly the healthcare system as we mean it, but the whole care online type of system, preventative healthcare type of system, is a company named HIMSS. And HIMSS is a company that I stayed away from for a very long time because I thought the product was odd. And it's when you don't dig deeper into HIMSS, you're like, well, why would I invest into that? That sounds so weird. But no, when you look under the hood of a company like HIMSS, you realize that they have a grand plan for creating what I call a blue ocean. I don't know if you've read the book Blue Ocean Strategy, which is a major book of business to create an uncontested white space. So they're creating a new type of healthcare, which is what one could call preventative healthcare, which is what I personally call healthcare. Because I call things like the health insurance system, the hospital system, I call this sick care. And when it comes to healthcare, I really put HIMSS in there. And so HIMSS, quickly, what do? They sell a lot of products, subscriptions by mail. So what you do is you get the HIMSS app, you see a doctor through the HIMSS app, video conference, and then you get the prescription that you need for typically issues that are minor, that are recurring, but also issues that have a strong impact on your emotional health, your mental health. So, for example, the typical product that HIMSS does, for example, is hair loss for men, hair loss for women. It's it's never covered by traditional healthcare, but clearly it could it could hurt, right? It's part of the holistic whole person care. It's like, yeah, if you're a woman, you've loved your hair forever, and you're losing your hair all of a sudden because you're in your late 30s, you're busy, you're stressed, you're losing your hair. Your life may be falling apart because you love your hair and you don't want to lose your hair. And they do the same thing with ED, and they do the same thing with anxiety. And there's a lot of good stuff going for HIMSS, creating, I believe, this new type of healthcare, which is really about living healthfully and not just living. It's about healthful life and not calendar life. That's a mega trend. That's a trend of technology. E-prescriptions, giant warehouses. You don't need an expensive hospital. You don't need a consultation in an expensive part of town. But it's also a trend of culture, I believe. And cultural trends are some of the strongest trend. The tech trends tend to get the lion share of mind share, right? People always think about the tech trends as like only growth, but you also have cultural trends that can lead to tremendous growth. And I'll get to some of these stocks later on. Let me move on now to another, and I didn't talk about Teladoc, by the way, but Teladoc is I believe not as compelling at all as HIMSS right now. I believe Teladoc, they did a poor acquisition. I used to own the stock, but two reports ago I sold it. I was very disappointed with that Livongo acquisition. I think they may have squandered a lot of shareholder money, and because they operate only within the traditional healthcare system, insurance reimbursement, they are less agile than I believe than a company like HIMSS. HIMSS operates entirely outside of the insurance system. Okay, let me move on. Not everybody's interested in HIMSS, so let me move on to the data stocks. I could rename this big data stocks, but I try to be a little more specific. I named it data warehouse, data monitoring SaaS stocks. So we have Datadog, Snowflake, Palantir, and MongoDB. And all I have to say is that if you followed this video on Fridays, over the 6 past weeks, these stocks have went from decent buys to insanely expensive companies. They are becoming expensive. They are becoming very, very expensive. I'm not adding to any of these. Datadog is infrastructure data. They are the leader in infrastructure monitoring. You gather millions of data points from your whole IT stack, and Datadog helps you see where there is a problem. It helps you spot a problem, detect a problem, and fix that problem whenever you see it within the company's IT stack. So it is a big data stock, even though it focuses on more of an infrastructure dashboard. It's the data analysis stock. Then you have Snowflake. Snowflake is a data warehousing stock, or rather a data lake, or at least they move towards a data lake. Data lakes are more for AI. Snowflake is a very interesting story. It's Snowflake versus Databricks. Snowflake tried to get into Databricks business. Databricks tried to get into Snowflake. Databricks is a company that's private, that hasn't had the chance to IPO because that window closed so suddenly. So let's keep in mind that Snowflake has a very fierce private competitor going against them. The reason why I sold out of Snowflake is because I found it to be way too expensive for that type of growth. And right now, I am considering trimming for the same reason, but I'm on vacation. These stocks have run up so much, but all of these stocks are up for trimming in my spreadsheet right now. All of them are up for trimming. I'm fully out of Snowflake. MongoDB, I have to get into the report. I have to look at it, but I will likely trim. MongoDB today, 30% up today. That's insane. That's a stock that's running ahead. It's too much too fast, and so given valuation, I wasn't too fond of a valuation a few weeks ago, but now at this valuation, 30% more today than it was yesterday, and really for a single-digit adjustment in guidance, I believe is exuberance to the upside. They updated the guidance just by single-digit to the upside. And the stock is up 30%. That's irrational to the upside too. So, and again, I wouldn't care. Like if a company like MongoDB was up 30%, but say it was trading like at a 0.5 or 0.4 or 0.6, I wouldn't care that much. But it's very expensive, right? It's nearing 1. So these stocks are getting very expensive. Of course, I'm not making any quick irrational decision. I have to do a full analysis of MongoDB, of Palantir. I think Palantir is getting a little expensive too here. Datadog is the only one that I'm still on the fence on, because Datadog, I believe, is quite a strong company with quite a strong monopoly. But this takes a while to analyze these stocks, and I'll be posting them on the channel with my decision. It may be that they're not overvalued. It may be, but this takes a while to analyze, and so these stocks right now require more attention because of their valuation. Let's move on to some stocks that require way less attention, and it's Crowdstrike and Zscaler. You see, they're right within my valuation framework. These stocks are performing really well. They're up quite a bit, but they're not way out of hand when it comes to valuation, so it's good. Quickly, Cloudflare, Net, teeny tiny position for me. Yes, it's expensive, but I do believe they have a very interesting play in cybersecurity. They're what I call the VPN for websites. They hide the website's IP address so that a website can't be attacked. They have a lot of optionality in the business. They seem to be going after Zscaler a little bit with their zero trust. Net is a company I like. It's just too expensive, so I'm not adding to it because it's too expensive, but not selling either. When it comes to Crowdstrike and Zscaler, I look at these stocks as a pair. I tend to own them together because each device, so what do these stocks do, right? It's like you join any company today, you're going to have a company laptop, right? Or a company device, whatever it is. On the edge, there's going to be a company device. That laptop typically is going to have two types of security. It's going to have the endpoint security. That's the Falcon software from Crowdstrike, and that's a software that uses AI to strike threats that attack your device and your network. And then it's going to have another layer of security, which is going to be zero trust, which means that whenever you when you have a computer that gets infected, let's say your laptop gets infected, for some reason Crowdstrike didn't work, even though they're a great tool. For some reason, they didn't work. Something went on and they didn't work. Well, then you want to make sure that only your laptop gets infected. Only your laptop and not the whole network. And that's what Zscaler does. Zscaler makes sure that each device does not infect any other device. So every single connection within every single device is secure, such that if someone's laptop gets infected, right? I don't know, someone puts a flash drive that they found on the side of a street and they plug it into the company laptop, and it just happens to be a virus and Falcon doesn't strike it, right? CrowdStrike doesn't strike it, then you're okay if you have a company, if you have Zscaler, because Zscaler really isolates your computer from the rest of the network. So you don't get the whole network impacted just because one employee did something wrong, opened an email they should not have. And that's why these stocks, I believe, go hand in hand. And Zscaler is the uncontested leader in cybersecurity. Reason for owning cybersecurity is because, it's a mega trend, but it's where security is headed today, right? I mean, used to be you go to the mall, you had a security guard at the mall. Today the mall is closing. Where is the security guard headed? The security guard headed is in the cloud. It's headed in the cloud, and it's coming from computer and software. So very powerful stuff, I believe. Mega trend. As far as the eye can see, I don't have any issue seeing 10 plus years of growth for these companies. Happy to own them, happy to not mind them, and sleep well at night with these companies. Move on to e-commerce. E-commerce is my oldest mega trend in this. E-commerce is old, right? I mean, it's 20 years old. Adoption of e-commerce in the US is fairly high. It's actually more than 30%, but it still has a ways to go. Peak e-commerce, when we'll be at the regular e-commerce going, what is that going to be? Is that going to be 80%? Probably, right? You're only going to go to a physical store for the experience. Right, you may go to a Whole Foods because it's a whole experience, good or bad. It's an experience, but you may not go to a Walmart anymore because you can just order everything online. So that's e-commerce for you. Is it a cherished experience to go into the store? Ask yourself, how many physical stores where you buy stuff are cherished experience? And I bet you most of them are not. There's only a handful of stores that have that cherished experience. And if it is, then those stores are likely safe as physical stores. If you just go for a physical store for the utility of it because you need to get stuff, you're going to get stuff online. At least that's my view of this mega trend. Of course, it's... I used to own Amazon back in the day, but Amazon is so mature now, and it's mostly a cloud stock anyways with AWS, that you have to look elsewhere in e-commerce, I believe, at least not in the obvious Amazon one. I believe you have to look elsewhere. Shopify, very expensive company, but they're the only company that really enables businesses to compete against an Amazon. Great business, well-run business, did not hesitate making the right decisions, over the past 9 months with all of the layoffs that they've had. CEO made a mistake, expanding warehouses, was a bad idea to do warehouses. They did layoffs, really well-managed company, but a lot of people agree with me, and the stock is very expensive because of that, so I'm staying out. The two e-commerce stocks that I really like are MercadoLibre and C Limited. I prefer MercadoLibre because I believe Latin America, I understand better than, say, Indonesia. C Limited is a leader in Indonesia and a lot of Southeast Asia countries. There's two reasons why I like MercadoLibre better. It's a more established company. It's a bigger company. It's an older company. It's better known, at least in its market. And unlike C Limited, it doesn't have that video gaming division. We saw C Limited when they reported. They still are suffering from that video game decline from their I can't remember the name of it, but it's a very popular battle royale something game that was very popular in India, that people stopped playing, mostly because it got banned and there were other issues, and so they're still hurting from their Garena division, which is the video game division, despite the Shopee division doing very well for C Limited. And C Limited also has competition from Lazada, which belongs to Alibaba. So there's some very, very fierce competitors in that part of the world, which you may not have as much of in Brazil, for example. MercadoLibre's biggest market is Brazil. It's really a wonderful company. I mean, and they got lucky too. Like MercadoLibre, the main competitor of MercadoLibre got bankrupt. Went bankrupt. Americanas went bankrupt. Anyways, I like MercadoLibre very much. I consider it to be one of the safer plays out in all of these stocks, in my view. No investment advice, of course. Payments. As far as payments goes, DLocal and Square, I am on standby on these. mostly because they're tiny positions, mostly because I haven't invested in the time. I will likely exit them at some point. I'm on standby on these. The reason is, and we've learned this with DLocal again a few days ago, right? Was it a week ago? I'm on vacation, but we learned it again. Where the stock is crashing in, that short seller is not letting go, and now Argentina's getting into it, and same for Square. Square is under attack by a short seller. Some of these short sellers can really, really hurt stocks. Ask any 2015 investor in Tesla, and they will tell you about shorts. Shorts can really hurt a stock and to be an overhang on a stock for a long, long time, 5-7 years. Ask anybody who owned Tesla in 2015 and you'll know what they think about shorts. So I'm very careful with DLocal and Square because they have short sellers that went after them. A company that I'm less careful of is StoneCo. StoneCo is yet another Brazilian company. Wonderful company. They are the Square of Brazil. They enable small businesses to accept card payments, but not only. They incorporate the new Brazilian central bank payment system, which is called Pix. They have this great app, this payment terminal. It's I believe a culturally relevant company in Brazil. They're sponsoring Big Brother Brazil, which is like the biggest show in Brazil. They have a lot of good stuff going for them, and they're growing quite a bit, and they're dirt cheap. So this company in the payment sector is my favorite. I've made a lot of video on StoneCo. Feel free to take a look at them. I've made a lot of them. It's one of my bigger positions, and I really enjoy StoneCo as a company. I believe they have a lot of potential for growth. They're setting up to be a duopoly with PagSeguro in Brazil. And I like StoneCo because it has a little bit of a better valuation, and I believe it's a little bit of a newer company. And because of that, it's a more agile company. PagSeguro is a little bit of an older company. If this types of stocks interest you, you get my thoughts in a nutshell here. Let me move on to another crazy part of this market, which is the chip makers. And I'll be honest, I love AMD. I used to say, and I've said it over and over again in these videos, AMD is the cheapest, most head of family sound type of stock, but at this valuation, it's kind of crazy. It's getting very expensive. These stocks are getting very expensive. Aside from Indie is a special situation stock. It's a special situation product, not a stock. There's no issue with the stock. But what they do is they provide ADAS system and LiDAR systems to the competitors of Tesla. So this is a stock that almost would belong in the energy revolution stock rather than chip makers. They're an OEM manufacturer, a tiny OEM manufacturer that grows really, really fast, and that really I have to put in a different category here. But if I'm to compare, AMD to Nvidia, which are somewhat comparable companies, or at least used to be before Nvidia went crazy, I believe right now these stocks went too high, too fast, especially Nvidia. Because yes, AI is wonderful. Yes, these companies are leaders in their field. AMD partnering with Microsoft on AI chips. Nvidia, the leader in GPUs. There's 8 GPUs for 2 CPUs. AMD is the leader in CPUs. AMD, the leader in integrated circuits with the Xilinx acquisition. They have a lot of good stuff going for them. But at this valuation, I believe it's important for someone to begin asking, how much am I paying for that growth? And you're really paying up. You're really paying up for that growth. You're paying up for everybody agreeing with you. And I agree. I mean, if you own NVIDIA, I agree with you. It's a wonderful company. It's an absolutely wonderful company. They're what they do. I mean, if you watch the keynote, I saw a few excerpts on YouTube of the keynote. Absolutely outstanding. I mean, we're gonna get into a world where you want to see a movie, you get a book, a novel, you feed that novel into GPUs, and then it makes you a movie in your language. I mean, it's amazing. It's amazing, and we're just a few years, presentation of Jensen Huang really struck me when he talked about a millionfold increase in 5 years, a millionfold increase. So this is an outstanding company with exponentiality, with S-curve. may have been a mistake to sell it. I mean, we'll see. Then the investor of me in 10 years may tell you it's the biggest mistake. May have been a mistake to sell it, but at this valuation, to me the stock got entirely overheated in my view. And AMD is nearing there. I still own AMD, but AMD is nearing that level. The problem is that all of the stocks have run up kind of together. So there's really no point in swapping when they all run up together, but you gotta find pairs and discrepancy within the pairs, right? If there's a pair with a discrepancy, that's why I've been adding a lot to HIMS and I've been adding a lot to Enphase lately, because those stocks have not run up nearly as much, even though those companies are doing very well in my view. And so it's really fortunate that some stocks run up too high and you can do some adjustments in the portfolio. Never stock adjustments though. Like always, never. I mean, this is just my view. This is how I do it. But that's from Ben Graham. Ben Graham, value investor. Obviously, I'm not a value investor. Lots of issues with value investing, in my view, in the modern world. But one thing was right is that there's a quote in Ben Graham that says, perhaps it is more important that the investor do something, that he must do something. They wrote like that back then. And what they mean is that the urge to tweak the portfolio, if you have that, which I do, if you have that, do it in 2% increments, 5% increments, not 100%. If you do 5 or 2%, you're not going to hurt the portfolio too much because each chunk of stock, the bulk of the stock, is really, really going to stay the same. But you got to be careful of. I believe that's just my style. But be careful of selling everything and buying it back and selling everything and buying it back. But if you have that itch to trade, that itch to tweak and ameliorate and do something to the portfolio. If you do a few percent there, a few percent there, I don't think it's going to hurt the portfolio too much. And at least it helps me control that addiction that I have to stocks. And keep in mind, stocks is an old addiction. I mean, it's funny to talk about this as an addiction, but it's a very old hobby. In the 40s and the 50s, you had the pink sheets and the newspapers. It's an old hobby. It's not odd. It's like people like that stuff. Anyways, always keeping in mind the enjoyment that I think we get out of this, and a lot of us get out of this. It's enjoyable. Some people enjoy casinos or horse racing or whatever, watching Netflix. I enjoy this. I think this is fun. Anyways, moving on. Ad tech. So yeah, the ad tech, in the ad tech stocks, the Trade Desk and Pubmatic. The Trade Desk I need to sell. I haven't sold it because of capital gains. I don't want to say. Sometimes you get into stocks where you have high gains on a stock and you just keep it, and you just gotta keep it. And to me, the Trade Desk is that situation, which is why I haven't done a video on them. A company that I like in the space is Pubmatic. As soon as we get signs, I believe, of a drop in interest rates, the market will start looking forward and be positive on spending, and be positive on company spending, on marketing, and marketing coming back. And obviously, when that happens, that will benefit a company like Pubmatic, which publishes on the sell side of advertising. That means that they sell advertising spots for publishers of websites, publishers of apps, right? They're not on the buy side. The Trade Desk is on the buy side of ad tech. Ad, very specific industry too. One of the things that I'll say about the ad business is that it's an industry of insiders. It's an industry of insiders. It's not as intuitive to understand, at least to me, as say something like engineering or tech or very logical stuff. Like there's stuff that are very logical. Anyways, I ramble. Topic for another video. I will cover advertising stocks though, but give me some time. But I'll cover them. Okay. Then I have my lifestyle stocks. So as I said, I would come back to this. Sometimes megatrends are not technological, and this is what those stocks are about. The lifestyle stocks. I have 3 lifestyle stocks: Celsius Holdings, Lovesac, and Figs. Celsius Holdings is an energy drink, very popular in the US. If you've been to any grocery store in the US, you see it all over the place. They sell out quite frequently. Actually, I buy it once in a while. I think it's better than, say, Monster, which is the example of a company that you would compare it to. You would compare it to Monster. If you look at what happened to Monster Beverage was one outstanding stock to own in the beverage space, despite all of the crazy competition in that space. It was one amazing stock to own, and Celsius is doing that again, I believe, with their energy drink, which is more targeting people in their 20s, their early, people that are into sports, not necessarily age, but people that are into sports. They kind of have that show of a more healthy drink. They've really found a niche in that marketing. And, part of that business trend or that business model is the age-old attempt at replacing coffee, which is kind of a 100-year thing, because if you look at, say, the history of Coca-Cola was the same thing. They were trying to replace coffee. So it's very interesting company. The one risk that I have about Celsius, so the growth is outstanding. The product adoption is there. People are adopting Celsius left and right. Product adoption is there. You see young folks with a Celsius beverage all over the place. It's a thing. It's a real thing. It's a cultural trend. The one thing that worries me is the partnership with Pepsi. They have a very strong partnership with Pepsi, which means that they may get acquired with Pepsi. In which case, you get a 50% pop in the stock. Yeah, I'm not investing for 30% in this channel. It's not good, right? I mean, there's 30% pop. No. Especially with volatility of the market. So one of the risks that I think is that a company gets acquired. I really hate when companies get acquired. I've lost good companies before that I've gotten acquired. You want to be able to own a company, not it be buried in a giant like Pepsi. But anyways, it's the way of the world, and that's just the way it is. Okay, let me move on to a micro stock, Lovesac. So Lovesac is, again, very, very cheap. The third cheapest stock in my universe. The reason why it's cheap is, as I always say, the market overreacted to the downside. They think nobody's going to ever buy furniture again, because obviously nobody's ever going to buy a home again, because obviously the interest rates right now, they're just too high. All of this is not true. People buy homes not because of interest rates. They buy homes because they need homes. This is one of the problems of classical economics versus Austrian economics. Austrian economics believes people buy stuff because they need the stuff, because they have benefit from the stuff. If you look at classical economics, well, you're raising interest rates, and so people are going to stop consuming. Well, it doesn't really work that way. You consume because... Anyways, moving on. The Lovesac, what they do is they're a furniture company. They are attempting to disrupt kind of the old world of furniture, and I made a whole video about this, telling about the cultural trend, the whole bean bag versus the lazy boy recliner. And ask yourself, new households, people starting out in life, are they more likely to buy a bean bag, or are they more likely to buy a lazy boy recliner that is extremely comfortable but may not really fit in a modern household? And that's kind of what they do for their furniture, and I believe they have very interesting play. Lovesac, the founder, also is very, very popular, very well known in design, and he's kind of achieved the dream of every designer, which is to have their reconfigurable furniture, or the furniture that evolves with you and that you can keep your whole life and make evolve with you. They've kind of done that in the furniture space, which is very interesting. This stock is dirt cheap. It's dirt cheap. It's got very productive stores, very, very tiny stores in fancy parts of town. Typically, they call it showrooms, of course. It's not like you're driving out with it. It's a showroom. That's the modern day of doing business. Lots of these brands have showrooms. They don't have stores. It's omni-channel. You just order it online, or you order it in the store, but you get it delivered anyways. I could talk about Lovesac for a while. Keep in mind, this is a company that's trading at one time, roughly, I mean, I'm exaggerating a little less, but rounding error aside, it's about one-time gross profit. One-time gross profit, rounding error aside. Absolutely outstandingly cheap. I like Lovesac. Moving on to Figs, I like it, and I like these stocks. Warranted, proper portfolio management techniques. Remember, number one stock is Tesla. Like you gotta adjust based on what you consider the most safe. The capital preservation is very, very important when you invest. Anyways, topic for another video again. You can see I miss this. I've missed doing YouTube. I've missed you all. Thank you for watching. If you've been watching this for a while, thank you. I've missed it. Okay, Figs. Let me run quickly with Figs. Figs is scrubs. They are trying to do what Lululemon did with the yoga pant. They are trying to do it with scrubs. And when I look at the data, when I look at the numbers, they're not doing too well. But you see, the problem is it's tough to tell whether Figs is not doing too well because the product market fit is not there, or whether they're not doing too well because of the fact that we've had such, high boom times. I'm going to call it boom times in healthcare in 2020, 2021. Very, 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 very high demand from the healthcare space. And we kind of have that overhang right now. And so it's tough to tell whether the tough time that they're having selling their scrubs, it's tough to tell whether it's related to the fact that there is this kind of an overhang in healthcare after such crazy good times for that sector in 2020, 2021, or whether there's a flaw in the business. It's tough to tell for me because it's a teeny tiny position, not even worth mentioning because of that. And in a few videos that I made a while ago about Figs, sometimes I wonder whether investing in Lululemon is actually a good idea, because when you look at the numbers, they're still pretty good, and their products are still getting adopted, and they're still selling yoga pants for like, I don't know, $100 or something. I mean, that's like software, like tech level gross margin. It's like something that should cost 10, they sell it for 100. It's maybe more than 100. I don't even know. I've never been in one of the stores. But anyways, very interesting. So I'll make a video on Lululemon as well. DigitalOcean and Axon, I haven't had time to update the spreadsheet. These are stocks that I've analyzed. I had pre-recorded as evergreen videos before my break, before my vacation break. They will be in separate categories, but DigitalOcean is a cloud a provider, right? They provide cloud services. They're an AWS competitor. They provide infrastructure cloud, and they cater that to small business. Their business is small business. They have very inexpensive payment plans. $30 a month, $50 a month to have access to a proper infrastructure cloud service. And they also focus on simplicity compared to Amazon Web Services, where you really have to have some skills now to use AWS, not to use DigitalOcean. They focus on simplicity. Interesting business, good company, growth a little low for me, a little disappointing, but the valuation is sound, and the sector is poised to grow, I believe, for the next 10 years, like a lot of these stocks. Axon is a company that I just analyzed recently. They focused on what they call stopping force, but a non-lethal stopping force, and they also focus now on evidence management and getting evidence for police officers. And it's a company that sells to police departments, essentially, mostly. Again, company is very steady. Company has been able to reinvent itself multiple times, 3 times actually. They do the camera now. They do the evidence. It's the growth avenue for this company is this cloud evidence management for whenever you go on a crime scene, etc. That's the bulk of the business now. But before that, they did the cameras, the body camera. So this is a company that has been able to innovate in a very interesting space, and it's an exposure I believe you can get nowhere else. Like if you're looking for uncorrelated asset, that's probably as uncorrelated as it gets. The problem again is the growth, again under 30%, so it's still technically under my threshold, and the valuation is getting a little pricey for that growth. Interesting company nonetheless. Interesting company. Let me run to the neobanks. Sorry if it's taking a while. The neobanks, SoFi ran up. There's a lot of hopes that student loans are coming back if that bill gets passed, which it seems it's going to get passed. It hasn't been signed by the president of the United States yet. But if it gets, I mean, who these things, I mean, it passed both houses. He's going to sign it, so it's going to pass. So that's going to be a big deal for SoFi. If student loans actually resume within 60 days, but we will see that. Keep in mind that SoFi has had a bit of a valuation reset, valuation upside, but the business to me fundamentally hasn't changed. It's just that the market perception of SoFi is still, this is a student loan company, and now student loans are coming back, and the market's going to be crazy. And Nubank has went up a little bit too. These stocks are still relatively inexpensive. The reason why you would invest in a neobank is because I believe that branches are the past. You don't need a branch anymore to do business. You don't, to do as a bank. You don't need a branch anymore. You need an app. You need a great app. And Nubank for Latin America has that app. SoFi for the United States has that app. These apps are connected. They resonate with Gen Z, resonate with millennials, Gen X, any age really, and they're much better apps. They're much better apps. If you ever bank with a traditional legacy bank, local, good luck. We may have a website. Anyways, you probably see what I mean, and you would have to believe that. And this is obviously where we've headed. The main reason for having branches is cash, getting cash out. Advice can be given over the phone in an app or over the computer. You can do virtual advice. You don't need to have physical branches to have in-person advice. In-person is gone. It's the way of the past, and this is the way of the future. So it's a mega trend, the neobanks, and I really believe in those. I will conclude really quickly with the platforms. Airbnb is a stock that is getting cheap now because now people are fearful that, there's going to be no more travel. I don't know what to say. When I listen to Airbnb, people are like, travel demand is weak. That's the new narrative. The new narrative is that people are not going to travel as much. I don't think so. I think Airbnb is the low-cost provider of travel for many types of people. It's low cost if you travel, say, with more than two. If you have more than two people in your traveling party, let's say you have an odd number, like 5 people, like you're a family of 5, Airbnb is going to be extremely low cost, because with a hotel you may have to get 3 hotel rooms, 1, 2, 3 hotel rooms. That's like a lot. So Airbnb is low cost for that. Airbnb is also low cost if you're trying to stay 3 weeks in one place, or 1 month in one place. And Airbnb is also low cost if you are trying to live in an area for just a few months. Oftentimes it's the only option, because traditional mom and pop leases will not let you rent a house for a few months, but you can do that with Airbnb. So they're a mix of a low-cost provider as well as an induced demand provider. All of that packaged in one of the most powerful business models of the 21st century, which is the two-sided platforms. It's a two-sided platforms in the sense that they provide no capital. The capital is provided by the sellers on the platform, and the customers come because of the sellers. So the customers sign up on the platform because of the network effects, because the best capital has been spent on properties that are listed on Airbnb. So this is a company, Airbnb, and that's the platform business model in general, that acquires capital through network effects. People want to come to the two-sided party because that's where the most customers are, and the customers are attracted by the two-sided network effects because that's where the best capital is, that's where the best housing is, the best apartments, the best villas for rent are, and they are just a toll on this setup. That is the platform business. In e-commerce, they'll call this sometimes a marketplace business, right? Alibaba is this very big, but Amazon also has a big marketplace business. Those two-sided marketplace, two-sided network platforms are absolutely wonderful. My favorite in there is Airbnb. There is also Etsy and Fiverr, although I have not invested in these companies. Mostly because I have Airbnb and I am waiting for a pullback. But I believe Fiverr and Etsy are very interesting companies. I've covered them on the channel. Unfortunately, the growth has stalled for both of these, so we'll have to see. Anyways, I don't even know how long this video is, but it's probably a long one. So I'll find out when I upload the file to YouTube. Thank you so much for watching. This is not investment advice. I have so much to say now that I don't publish my daily videos. They will come back as soon as I'm done with this vacation. Still have a few more time going on. But anyways, this is not investment advice. This is just entertainment. Appreciate your likes. Appreciate your subscribe. Miss you all. Thank you so much for watching. Have a great day, and I hope you liked the entertainment today. Thank you.